In our previous session, we discussed future value. Today, we are going to explore a new topic, that is present value. What if you have just won the lottery? The prize is 10 lakh rupees, but there's a catch. You can either receive the full amount today or receive 10,000 per month for the next 10 years. What do you think? Which one is the better deal? To answer this, we need to determine the present value of that stream of future payments. At the end of this topic, you will be able to explain the concept of present value. You'll be able to explain the concept of discounting. You'll be able to determine the present value of investment in varied scenarios. Present value is a critical concept that allows us to determine how much a future sum of money is worth in today's terms. By accounting for the time value of money, PV helps us assess whether an investment is worthwhile. To calculate present value, we use a process called discounting. This process reverses the compounding process we discussed in the future value lesson by bringing the future value back to today's terms using a discount rate. It's an important concept as it reflects the opportunity cost of capital, that is, the potential returns you forego by choosing one investment or decision over another. So how do we bring future cash flows to the present to make them comparable? The answer lies in the concept of discounting. Discounting is the process of adjusting future cash flows to their present value by accounting for the time value of money. It shrinks the future value of money to reflect its worth today, factoring in time and risk. Now, how is this concept of present value and discounting important? To understand this, imagine you are evaluating two investment options. One pays you rupees 50,000 5 years from now. The other pays you rupees 55,000 6 years from now. For once, the second option sounds better because it offers more money. But only by discounting both amounts to their present values, you can determine which investment truly gives you the higher value in today's terms. This technique is essential for comparing investments, pricing financial assets, and making decisions about loans, projects, or even everyday financial choices. Now that we understand the concept of present value and discounting rate, let's explore how to calculate it mathematically. The present value formula is essentially the reverse of the future value formula. It discounts future cash flows to their present value using a specified discount rate and time period. It allows us to determine the current worth of a future amount of money by accounting for the time value of money. Let us look into the components of the formula, PV. This is what we are solving for, the value of a future sum in today's terms. FV, future value, the amount of money you expect to receive or pay in the future. I, discount rate, the rate of return or interest rate used to discount the future value to the present. This rate reflects the opportunity cost of capital or the return you could earn elsewhere. N, which is number of periods, the time period over which the money will grow or be discounted. Let's now apply what we have learned about the present value to a single cash flow scenario. As we have seen the formula for present value, let us take a simple example and calculate the same. Now suppose you are promised 1,000 rupees 2 years from now, and the discount rate is 5%. To find out the worth of this money in present terms, we have to use the present value formula. Here, future value is rupees 1,000, interest is 0.05, N is 2. Putting these values in the formula, we get present value is rupees 907.03. This implies that 1,000 rupees 2 years from now is worth 907.03 today if the discount rate is 5%. The present value of a single cash flow tells you its equivalent worth today, accounting for time and the opportunity cost of capital. Now let's move from single cash flows to a series of equal cash flows, often referred to as an annuity. This is a common scenario in finance where equal payments are received or paid periodically, like monthly rent, annual salaries, or loan EMIs. The present value of an annuity represents the current worth of a series of equal periodic cash flows. Present value of an annuity, PVA, is equal to periodic payment, A, multiplied by 1 plus interest rates, I, raised to number of periods, N, whole minus 1 whole divided by inside the bracket interest rate, I, multiplied by 1 plus interest rate I raised to the number of periods n. PVN is the present value of annuity over n periods. A is the amount of each periodic cash flows. I refers to the discount rate per period. N refers to the total number of periods. To understand this better, let us take an example. Suppose you are to receive rupees 50,000 per year for next 25 years and the discount rate is 6%. Now here A is equals to 500, N is equals to 4, I is equals to 0.10. Putting all these values in the formula, we get PVA is equals to 50,000 bracket open 1 plus 0.06 to the power 25 minus 1 close the bracket divided by 0.06 1 plus 0.06 to the power 25 is equals to 6,38,750. This means that the present value of receiving rupees 50,000 annually for 25 years at a 6% discount rate is 6,38,750. Not all financial scenarios involve even or consistent cash flows. In many cases, cash flows vary over time. For example, a business might expect increasing profits over the years or irregular rental incomes. In such cases, we use the present value formula for each cash flow individually. For uneven cash flows, we discount each payment separately. For example, rupees 1,000, rupees 2,000 and rupees 3,000 received over 3 years at a 10% discount rate. To calculate this present value, we discount each cash flow individually. For year 1, PV is equals to 1000 divided by 1.1, that is 909.09. For year 2, 2000 retake. For year 2, 2000 divided by inside the bracket 1 retake. For year 2, 2000 divided by 1.1 to the power 2, that is equal to 1652.89. Similarly, for year 3, it will be 3000 divided by 1.1 to the power 3, which is equal to 2253.94. In order to calculate the present value, we have to add all three values obtained for each year. So the combined present value of 1000 rupees, 2000 rupees and 3000 rupees received over 3 years at a 10% discount rate is rupees 4815.92 rupees. Unlike regular annuities, which have fixed duration, a perpetuity involves equal cash flows that occur indefinitely. The formula for the present value of a perpetuity is PV is equals to A divided by I. Here A is the constant annual payment and I is the interest rate expressed in decimal form. For instance, receiving rupees 1000 annually forever at a 5% discount rate has a present value of rupees 20,000. The capital recovery factor is useful when determining equal periodic payments for a loan or investment. The reciprocal of the present value annuity factor is called capital recovery factor. In the formula of capital recovery factor, A is the equal periodic payment, P is the present value of the loan amount, I is the periodic interest rate expressed in decimal form, N is the total number of periods. Let us apply to this an example. Let us apply this to an example. Suppose you borrowed 10,000 rupees from a friend and you need to repay it over 5 years at an annual interest rate of 10%. To calculate the annual repayment in this case, PV is equals to rupees 10,000, I is equals to 0.10 and N is equals to 5. Putting all these values in the formula, we get an annual payment of rupees 2,638. The capital recovery factor provides a systematic way to distribute payments over time, ensuring both the principal and interest are covered evenly. It's an essential concept in structured finance and budgeting. Now that we have explored how present value is calculated, let's focus on its significance. Present value calculations are fundamental in finance because they allow us to evaluate and compare the value of cash flows occurring at different times. This is crucial when deciding where and how to allocate resources effectively. Evaluates the worth of future cash flows. Suppose you are offered rupees 10,000 payable 5 years from now. Is it worth rupees 10,000 today? Probably not. This is where present value calculations become important. They discount future amounts to their equivalent value today. considering factors like opportunity, cost, and inflation. By doing this, we can determine the real worth of money received or paid in the future. Second is helps in investment decision making. Present value is the foundation of investment analysis. For example, when assessing whether to invest in a project or not, you compare the present value of expected returns to the initial cost. This is how tools like net present value help in deciding if an investment is viable or not. Essential for bond and stock valuation. PV plays a critical role in valuing financial securities like bonds and stocks. For bonds, the present value of the future coupon payment and the face value determines the market price. Similarly, stock valuation often uses discounted cash flows models to estimate the intrinsic value based on expected dividends or earnings. Let's consider an example of bond valuation. A bond paying rupees 1000 annually for 10 years and maturing at rupees 10,000 with a discount rate of 8%. Calculate the present value of the bond. We need to discount both the annuity payments, which is rupees 1000 per year for 10 years, and the face value, which is 10,000 rupees at maturity using the discount rate. Calculate the present value PV of the bond. We need to discount both the annuity payments, which is rupees 1000 per year for 10 years, and the face value of rupees 10,000 at maturity using the discount rate of 8%. Step 1. Present value of annuity. Annual rupees 1000 for 10 years at 8% discount rate. PV annuity is equals to 1000 bracket open 1 minus 1.08 to the power minus 10 divided by 0.08. PV annuity is equals to 1000 into 6.7101. PV annuity is equals to 6710.08. Step 2. Present value of maturity amount, which is rupees 10,000 in 10 years at 8% discount rate. PV maturity is equals to 1000 divided by 1.08 to the power 10. PV maturity is equals to 1000 divided by 2.1589. PV maturity is equals to 4631.93. Step 3. Total present value of bond. PV total is equals to PV annuity plus PV annuity. PV total is equals to 6710.08 plus 4631.93. PV total is equals to 11,342.02. Stock valuation often uses the perpetuity concept. For example, a stock paying rupees 100 annually forever with a required return of 10% has a present value of rupees 1000. This approach is commonly applied in dividend discount models. In this session, we have learned that present value is the current worth of a future sum of money or stream of cash flows. Discounting is the method used to calculate the present value of future cash flows. We have also learned calculation of present value is very much crucial for evaluating investment opportunities, making financial decisions, and understanding the impact of time on the value of money. That's all for today. Thank you and happy learning.